This is Iberian Property Insights, an initiative aimed for those who want to be updated on the Iberian real estate sector. My name is Alexander Lima. In today's episode of our podcast, I'm honored to have with me Federico Bros, Head of Investment and Asset Management for both Spain and Portugal at M&G Real Estate. Federico, welcome, and thanks for accepting the invitation to discuss what 2024 may reserve for the Iberian real estate sector. Correct me if I am wrong, but I believe M&G is among the top 10 of major investors in real estate in Europe, right? Would you like to start by telling us a little bit more about the company history? Who is M&G, and what relevance does Iberia have in your portfolio?
Thank you to you for the invite. So M&G Real Estate is a real estate investment arm of M&G PLC, which is a global investment company. We have 388 billion of assets under management. And M&G Real Estate is part of the private asset division of M&G. And this private asset division manages around 86 billion of assets under management, of which real estate represents around 36 billion. So it's right to say that we are in the top 10 of investors in Europe, and globally we are around the number 25. So it's one of the main investors, and one of the characteristics of M&G Real Estate is that we are asset owner and also asset manager, and that gives us competitive because in all the different products we have different funds, we have segregated maintains, joint ventures, and co-ownerships with other partners, basically bespoke solutions. So normally, in most of the cases, we also contribute with our own capital, and also we have a very experienced different local teams. So we have presence globally. In Europe, we have 7 jurisdictions in which we have a local office. I'm heading the business for Iberia, as you mentioned at the beginning. So we cover here Spain and Portugal. And in Europe in total, M&G Real Estate is managing around 7 billion, of which circa 1 billion is the assets under management for the Iberian portfolio, of which 70-75% is Spain, and the other 25% represents assets, different properties in Portugal. So that's the main footprint, and we believe that having such a footprint and local offices is very, very relevant for assets that compared to the spectrum of financial assets are very liquid assets. You need a local experience and local knowledge.
A very large and global experience. Despite a challenging macroeconomic environment and also capital raising environment, M&G has invested more than 2.5 billion euros in Europe over these last 2 years. Besides your focus on long-term leases with very good governance behind it, what other key factors do you look for when it comes to invest?
Yeah, I mean, long leases is, as you mentioned, is one of the main elements, but basically we look at long-term sustainable returns for our investors. So that's the main target. So we should pass over 2.5 billion in the last 2 years, just in Europe and UK. In the last 3 years, it was 4 billion, and basically 6.5 billion across the globe. So basically, that's been in this, let's say, especially in 2023, a difficult market environment. And for us, what is very relevant. So we have decades of experience in selling, buying, managing assets. So and look fundamentally is a structural favorable trends. Like demographics, location, quality of tenants, and now that's something very trendy, ESG. So basically, as long as you have portfolios that tick all these boxes, so where the location is good, good quality of tenants, with Indian, basically you can fulfill your commitment with investors and provide a long-term sustainable return. So that's really the main focus for us.
Well, I'd like to pick on the location that you mentioned, because in the last months, M&G completed acquisitions in the living segment in both Portugal and Spain, Specifically, you acquired the student residence in Lisbon and 2 turnkey residential towers in Bilbao. Spain and Portugal, secondary cities, seem to be moving at different paces when it comes to capital attraction. Do you agree with this, and what do you think may motivate it?
Yeah, so it's very relevant to distinguish between Tier 1 and Tier 2 cities. So basically, many investors, international investors, consider in Iberia, Lisbon and Porto in Portugal, and Madrid, Barcelona as Tier 1 cities. And that's very generic, because that's true for some specific asset classes like offices, in which in the end investors are looking for cities which are Tier 1 because of the liquidity of the assets. So they don't only think of the returns they get, but also how to exit in the medium long term. But there are other asset classes like living or logistics, in which there are other aspects that you need to take into account. So basically, you could say that Seville, Bilbao could be Tier 2 cities in relative terms to Madrid and Barcelona, but in the end, for living, for us, it's really a Tier 1 city, in the sense that there are strong fundamentals, demographic trends, so there is a strong imbalance between supply and demand. Seville, as an example, is a city that attracts a big number of students, so the PVSA asset class is really performing well. Other examples could be Valencia or Salamanca, so other cities which are student cities. And the same with logistics. So basically, you could have logistic assets, properties in Valencia, in Seville, in Malaga. So in cities which are really connected to the different distribution corridors, next to ports, and also in that sense could be considered prime cities for logistics. So we need to be careful when we say secondary versus prime cities, because it depends on the specific asset classes. But in the end, what is relevant is that you focus on micro locations that are really performing well. So it doesn't matter whether you are investing, for instance, in living. So in the end, you need to be sure that in this specific city, there is an imbalance between supply and demand, and the fundamentals of the market are there. Because now we see, for instance, in offices, that even in Madrid, there is a polarization between prime locations, secondary locations. So M&G is in favor and looking at the long term of investing in prime CBD areas, where in the end the offices are performing better than periphery.
Very good. Federico, time for a tricky question. Looking backwards, what transactions would you like to have completed but were not able to, maybe to enter a specific sector or a city?
Yeah, M&G has a strong track record in the living sector. So we have around a global portfolio of around 4.9 billion, 2.9 billion in the UK, 0.4 billion in Europe. And it's been 23 when we have closed a transaction for a development of 2 nice resi towers built to rent project in Bilbao and a PVSA accommodation in Lisbon. But doesn't mean that we start in 23. We have been trying hard in the last 2 years, and we were late for different reasons, but in some cases we were second bidder. And now, finally, we were very successful this year. So I remember an opportunity in Valencia, which is a city that has very, very strong fundamentals for living. So there is some lack of supply there. And we missed a very good opportunity. We were the second bidder. And also for different pockets, in which in this case was more a value-added strategy, we were trying to acquire offices in Madrid city center and Barcelona, and also we were in the process. We were second or third bidder, and we missed that opportunity. In that case, was projects to reposition the offices. One of them, and the other was for a new development. We are doing something similar in Lisbon. We have a prime CBD office building. In that case, it worked pretty well. But potentially, answering the question, I think this one, especially on living, we are already on playing a good game, but maybe ideally would have been better to start a year before.
Going deeply into living, I recall that at the beginning of the year, we talked about municipalities' new affordable housing programs. Are you finding any compelling opportunities in this segment?
I mean, the segment itself either is affordable housing or let's say the normal residential is very attractive for the main reason that, especially in Spain, there's a lack of supply. So depending on which source and the time horizon, but in the next 15 years, according to the National Institute of Statistics, the population is going to grow from now we are around 47.5 million to 52, so it's going to be almost 5 million population growth, not because of the birth rate, which is a negative side, but it's because of immigration. And also another trend is the size of the household. So we are over the European average, and we are moving in the direction to be aligned with the European Union, around 2.2 people per household. And that's going to imply different elements. So the main one is that there is a lack of supply, and we are lacking for the next 15, 20 years of more than 2 million, between 2 and 2.5 million. So there are plenty of opportunities. And I think some of these opportunities are coming for affordability, and there are very good schemes, for instance, subsidized by different regional governments. And good examples is in the Basque Country, where there is new affordable housing. In that region, for instance, one of two tenants has a kind of protection from the public system. So basically, the Basque regional government is really supporting investors and also tenants, because they either give direct support to investors to develop a new affordability housing, or to regular citizens. But the same with, for instance, Plan B in Madrid. So there are opportunities, and in the end, it's not just that you are getting the returns the investors are looking for, but also you are contributing to the society. Because in the end, one of the main aspects of M&G is being a responsible investor. So we just not try to get very good returns for our investors, but we also try to build, manage, and acquire assets that in the end promote environmental excellence, or health, well-being, and for especially for our tenants. In this case, in the case of living for ordinary people. So I think that's something we are very focused on. We would like to grow.
In a European context, it is often said that Iberia takes longer to correct prices when compared to other major European markets. Do you find this statement to be true? And more important, do you believe we are still lacking a real correction on prices?
Historically, especially for institutional investors, so normally when there is allocation to regions, so Spain is included and Portugal in Southern Europe, and the allocation is always in percentage lower, overall. I'm talking overall, lower than France and Germany. And it's true that historically, looking at the deal's evolution, we have been a bit behind, especially Europe compared to UK, and also we mirror with the US. So normally all the trends, things happening in the US, 6-9 months later are coming into Europe. There's been already a strong deal corrections after the grain war and all this inflationary environment. So we have seen most of the correction already taking place in Europe and also in Spain. In that sense, I think right now we are quite aligned. And I remember at the end of 21, so before the grain war, logistic yields were at 3.75 and are already over 5. So all the correction has already happened. Still not. So now we are in the last part of 2023, in the last quarter, the valuations are going to imply some still adjustment and potentially something more in Q1. We need to understand that core inflation is still not under control. Interest rates are over 4.5%. So and basically we are still living in an environment where inflation is high. But most of the correction has already happened. And I think the low level of investment in the real estate market in the year has been because of the this correction that is still need to happen. But let's say that most of it is already happening in all asset classes, especially logistics, but potentially offices and some other classes still there is further correction to take place. But I believe 24, from an investment perspective, is going to be much better year than 2023. We see overall in Europe a decline of over 50% in all the countries. And that's really because of this yield expansion. So apparently, Looking at most of the sources, the interest rates already peak, and most of the market and investment sentiment is that the interest rates will go down little by little, a very, very, very slow speed, but and low path, but basically they will go down in the next 2-3 years. And I think yields are still a bit behind.
Yeah, indeed, we start to see some signs that transaction volume in capital markets may have bottomed out globally. In your opinion, Federico, is uncertainty going to still be constraining investment decisions throughout 2024, or is at least starting to begin to fade away a little bit?
I think now in valuations, as I mentioned before, for the end of the year, there will be a further adjustment, depending on the asset class, but we'll see potentially a move of 15 bips, 25 bips in some of the asset classes. And I think there's still some more correction in Q1. So I think the sentiment, investment sentiment, is going to be very quiet the first part of the year, and we expect the second part of the year more transactions and everything to be reactivated. Because in the end, there's plenty of liquidity. So and it's also, there's financing available, and we have on the system also alternative financing, alternative funds. So basically everything is ready. So now we need to align the profile or the sentiment of sellers and buyers. And I think we are getting that point. 24 is going to start in a very low phase, but little by little during 24, we will recover speed, and I think we will get back to normality at a different level price, basically.
Do you think 2024 will be a year where we will witness the entrance of new players or the uprise of new segments?
I think at this level of deals, especially in some cases, we will see some distress because there are overall many investors that need to refinance portfolios, and some of them will be for different reasons to be obliged. So I think core investors have been very active in the last years, and now we will see a trend of value-add opportunistic investors coming into Europe. And I think we will see more value-add transactions than in the last 2-3 years, for sure.
Very well. Federico, if you had to elect one, what will be the big trend for the next months or the next year?
I think for the next year, ESG. Basically, that's the main one, but not just for the next year. It's going to be a structural trend. So basically, most of the institutional investors are really making commitments in order to achieve net zero carbon emissions across the global real estate portfolios. So in the case of M&G, our commitment is to achieve that target by 2050, and you cannot wait for the next 20 years. You need to start. So everything has been already started. So I think the trend is that big portfolios, asset management companies, they will be focused on really obtaining certificates and try to enhance the operational efficiency, energy efficiency of the buildings. In some cases, it's because the regulation is coming in different sectors, like in the residential sector. There's some obligation, depends on the countries. But in other cases, it's because of it's really the institutional investors are requiring that. So I think we have been always a very responsible investor, very focused on that. And we have, for instance, in our global portfolio, more than 30% of the portfolio already certified. In the case of Iberia, it's 100% with a green certification or in the process to obtain the certifications, either free or LEED. Mm-hmm. And I think the trend is that for new acquisitions in general, not just M&G, which is really a focus, but that's it. I think that's a global trend. As long as, unless the assets, the properties that are going to be developed, in case, for instance, of build-to-rent or the existing stock has a very efficient energy system, an environmental certificate, it's going to be very difficult to get a value, because otherwise the asset is going to convert a very liquid asset. It's not just a matter of whether the price is going to be lower, it's also a matter of getting the proper value. So I think ESG is in the agenda for most of the institutional investors, and you need to be, as an investor, very focused on that, very conscious, that otherwise you will be out of the game.
Can you already quantify what is the difference between a non-compliant ESG asset or one that is indeed with a good certification?
In terms of price, still, people talk about a discount on valuation. I think in Europe it's not clear. But what is true, and it's for sure, is that there are many institutional investors that are not able to acquire an asset with a specific level of ESG credentials. In our case, for our pan-European living strategy, and that's an example which probably many people is doing the same, unless we have a BREEAM very good or excellent or LEED Gold, we cannot acquire a new living product. So basically, when you talk to different developers and they have as a target BREEAM good, it's not enough for us. So unless we are able to manage to obtain BREEAM very good, there's no deal. So basically, I think it's not just a matter of how much is the discounting price. It's in many cases that there will be an opportunity if the asset doesn't have a minimum ESG credentials. I think it's good for the society, and I think we are in the right move. It's a general trend which is very positive.
Very well. Federico, it was lovely to talk with you. I hope our listeners find this episode as interesting as I did. Thank you once again. This was Iberian Property Insights, powered by Grupo Iberian.